The fact that reinvesting dividends helps you grow your portfolio is undeniable. Anyone in doubt can read this chart and see for themselves. It models Coca-Cola stock growth based off past 5 years, and you see clearly that with initial investment of $10K, you're going to be much better off in the long run if you reinvest it. Same as if you'd reinvest some $50 each month. It's just a no-brainer that when you can, you should reinvest. But reinvesting dividends is just taking the dividend and buying the same shares. Simple as that, right? Well, hell no. I mean, you can just do that, but if you want to maximize your returns and avoid some of the stress, then I'll give you a few easy hints to follow to grow beyond what you've just seen. These are targeted to ultra-high dividend yield strategy, but it will benefit any kind of dividend portfolio. 1. Let's say you've invested into some high-yield dividend stock. You cash in your first dividend and you're smiling ear to ear. Boom! You've just become richer. So why would you bother giving that money away and reinvesting? Firstly, you can boost your return by extra 0.2 to 0.5% a year. And if you're thinking, wait, that's like almost nothing, then you would be very short-sighted. I mean, if you're looking at this through a lens of a single year, then yes, it's almost a negligible amount, but it can at least cover your ETF's expense ratio in its entirety in most cases. If we're speaking years from now, then remember the picture from the video's beginning. We're talking thousands or even tens of thousands of dollars. We will cover this in detail in a 6th point, though let's just close the point number 1 with the conclusion that reinvesting as often as possible helps you grow your portfolio and income. So if you have money on the side that is not working for you, then put it to work, period. 2. This is gonna be a biggie. Say you're in a position where after paying your rent or mortgage and all of your monthly expenses, you're left with some $400 to $800. Now say that you've been receiving a bonus and you have $2,000 you can invest. If you decide to buy something a bit more expensive, say J&J stock, ticker symbol J&J, that should give you 12 shares, $164 each. The investment would return $12.72 a quarter. Okay, so what should you do now? You wanted to become an investor to have more money, and now you would need to invest additional $152 to be able to reinvest into a new stock. And you fool thought that investing would make you rich. Now you're going to be $150 short every 3 months if you want to reinvest. A little discouraging, isn't it? Well, you may choose a different asset. Say Marathon Oil's MPLX, limited partnership, ticker symbol MPLX, obviously, with stock price of $28.76, dividend yield of 9.56%, and quarterly payout, you may expect to see about $47 of dividend income a quarter, allowing you to buy an additional share each quarter and have almost $20 to spend or invest elsewhere. So the well-earned $400 to $800 you have each month don't need to be touched at all, and you would have self-sustaining investment. You see the difference, right? 3. Pay attention to the frequency of dividend payouts if you want a self-sustaining investment. Imagine that the MPLX paid dividends once a year. Then you would need to buy 11 shares worth $316 to be able to reinvest the dividend into a new share. With quarterly dividend payout, this grows to 42 shares and $1,208 of investment, and with monthly payout it goes to 126 shares and $3,624. Although there are quite a lot of stocks that pay yearly dividend, such as Polo Commercial Real Estate Finance, ticker symbol ARI, they have a stock price of around $15 and dividend yield of 9.17%, just to provide an example. I would not advise to invest in these for a very simple reason though. The more reinvestment periods you have, the more you're able to grow your portfolio. If you invest just once a year, then you enjoy the effect of extra share only in the second year. Whereas, if you've done that in the first quarter, then the effect would last 9 more months with extra share added to the portfolio each quarter, and same goes for monthly reinvestment. Though, as we're diluting the already smaller dividend yield, there isn't a big of a difference in going from quarterly reinvestment to monthly reinvestment. So to conclude, I advise you to stick with quarterly dividend paying stocks. 4. There are platforms that allow you to buy partial shares. This makes complete sense when you're buying growth stocks, and half of let's say a Tesla share that grows 10% in a month means that your half also has grown so much. But partial shares don't pay partial dividend. In fact, they don't pay dividend at all. So if you reinvested your dividend into a new stock and you're left with some $11, what can you do? Well, you can spend it anywhere you want to, literally. But my take on this would be to try luck with penny stocks. They offer very high returns and the money you may lose is rather small. In this case, you may lose $11, but on the other hand, you may earn multiples of the initial investment if you're lucky. I would share my picks on penny stocks later on this channel. 5. Another point that concerns your trading platform. If your trading platform charges per trade, then make sure to count that into your reinvestment plan. Just as an example, imagine that you were investing into stock that costs $20 with monthly dividends, say something in line of QYLD, and you now add fee to the formula. Say that your broker asks $1 per trade. This would mean that you would be losing 5% on reinvestment if you'd be buying a single share. It would then make much more sense to reinvest less often since no stock returns 5% in a month. This usually isn't a problem if you charge a fraction of the investment. There the fees tend to be much smaller. But in any case, check your fees. 6. The longer you spend reinvesting, the higher the returns are gonna be. Don't think so? Well, let's then look at the Coca-Cola example again, or J&J, or any other share you may find. Difference after 25 years is huge. And what about 35 years? You get it now, do you? But hold on, not everyone has that much time to wait. Some of us may be in the retirement age already, or you may have other reasons why you can't invest for long term. Or indeed we may want to enjoy the dividends earlier, as if that isn't why we started to invest in the first place. If your investment outlook is less than 5 years, then I would not care about spending the dividends. If it's more, then I would suggest reinvesting them, and if you would be in the need of using some of the money, then hey, it's your money. It will mean that you would have a little less in future, but who am I to tell you that you can't enjoy what you've earned? To sum it up, no, reinvesting isn't completely straightforward, but to maximize your returns isn't hard either. So, what are you waiting for? Go ahead. And by the way, thank you very much for watching.